So I'm just gonna do this. All right, I'm gonna mute everybody, and then I'll let you talk in once we get to the end. That way we don't have anyone coming here and hitting mute or unmuting. Perfect. All right, so let's dive into it now for real this time. So my name is Colin, also known as the Decade Investor. So you might have seen my stuff on social media or within the Wealth Squad. This is a little bit about me. This is an old picture of me. This is like 2 years old. I've lost some weight. You know, I run now. I'm a runner, but I'm 22 years old, almost 23. I'm a long-term investor. So I don't do any trading right now or any options. So it just in the future, when you ask questions to me at the end of this or in general, I don't have that. I don't do that kind of stuff right now. I'm solely focused on long-term investing. I'm 80% index funds, ETFs. So most of my investments are in index funds and ETFs, and 20% are in individual stocks, mostly in dividend stocks. However, I do have some non-dividend paying stocks like Carnival Cruise Lines, Royal Caribbean, which if you own those, they did really well today in the market. Social media, like I said, Decade Investor. So that's my Twitter down here at the bottom, at Decade Investor. Also on Instagram, at Decade Investor. So you can check me out there. If you have any questions and I don't get to you during this presentation, you can always send me a message on either Twitter or Instagram. And I will get to you when I can. Sorry, just muting some people. Okay. So that is my social media is right there. So Twitter and Instagram, come check me out, ask me questions, and I will get to you when I can, as soon as possible. That's where I spend most of my time. So I just want to kind of start off this presentation by just talking about savings accounts and why I'm against them when it comes to building wealth. I did a similar presentation last month in the Wealth Squad. It's kind of like this, so you might see some same slides, but the information doesn't change because it's relevant for everybody. But I am against savings accounts for building wealth. Now, when I say that, I do not mean that you shouldn't have a savings account, because that's why I hold my emergency fund. My emergency fund is something where you go in and you need that money in 3 to 6 months or a year, but it's the fund to have for emergency. Your car breaks down, your AC goes out, your heat goes out, something happens. It's for emergency funds, for emergencies, and that's where your emergency fund is. So that's why I hold my emergency fund is in a savings account. But when it comes to building wealth, this is not where you want to be. A savings account is not where you want to be. Because, like you can see on the screen, the national average interest rate for savings accounts is 0.05%. 0.05%. That's horrible. And again, you can build wealth in a savings account, but it's going to be super, super slow because 0.05% is horrible. We can see here, I put up a screenshot of 2 different investments. So the first one here is a $500 starting balance, 8% annual return. So this would be like investing in the stock market. You add $50 a month for 20 years. The second investment is the same $500, the same $50 a month, the same 20 years, but the difference is the interest rate, which is 0.05%. So investment 1 would be like investing in the stock market. Investment 2 would be like putting your money in a savings account to build wealth. Investment 1, after that 20 years, is $32,000. Investment 2, after that 20 years, is only $12,000. So just the big difference here is this total interest, right? Both types did $12,000 in that 20-year span, what they contributed, but the interest was almost $19,600 versus $65. So savings accounts are great for your emergency funds and maybe having some short-term money in there if you're trying to save for a house in the near future. But when it comes to building wealth, it's not going to be possible in a savings account. You need a lot of money to do that, and 0.05% is not a path to building wealth, especially in a savings account. So just a note with here, this before we get into it, I recommend all new investors start with index funds and ETFs, right? Learn how the market works, put your money in there, diversify your money between, whether it be a S&P 500 fund, a total stock market fund. That's why I recommend all my new investors start is with those, learn how the market works, kind of understand the ups and downs of the market. And you're, again, able to diversify your money into those index funds or ETFs. However, in this presentation, I'm going to go over individual stocks. So I'm not going to really talk about index funds or ETFs, but just keep in mind that because I'm talking about individual stocks, I'm not against index funds or ETFs. That's where I hold most of my money, and I recommend all my new investors start there. When it comes to individual stocks, the great thing is more risk equals or could equal more reward, but it also could equal more loss too. So when you're picking individual stocks, you're not as diversified if you are in an index fund or an ETF. So you have that more risk, which could equal more reward, but it could also equal possibly more loss too. Another thing to keep in mind is with individual stocks, there is a more research and time spent on researching all of them because you have to research 20, 10 stocks versus just one broad market index fund or ETF. And then this, like I said earlier, diversification of that index fund or ETF, putting your money in there and it's automatically diversified between hundreds, if not thousands of companies, is something you can't beat. And it's hard to replicate when you're doing individual stocks. But like I said, this presentation will go over individual stocks, but just keep that in the back of your mind that if you're new to investing, I always tell my new investors, start with index funds, ETFs, learn how the market works. And then if you want to go and pick individual stocks, then go do it. But just play it safe and learn with index funds or ETFs. So how do I pick my individual stocks? So personally, like I said, 20% of my money is in individual stocks, mostly in dividend stocks. However, some in non-dividend paying stocks like Royal Caribbean, Carnival, Delta, Southwest, just to name a couple. There are a few factors I look for. I'm going to go through these here in the next following slides, but number one is historical performance of the company. So how has the company or the stock done in the past? The second thing is the future growth of the company. Now, this is something we have to predict. We don't know this. It's something we have to guess and assume and predict. The third thing I like to look at is if it's a dividend stock, is the dividend history, and also the dividend future. So what's the future growth of that dividend, as well as just the current standing of the company, right? What's it look like today? How's it look present day? So there's two types of ways to look at individual stocks. The first is technical analysis. The second is fundamental analysis. The first technical analysis is basically doing a lot of charting, doing a lot of looking at metrics. So like PE ratio, all these different metrics. We'll get to them at the end. Earnings per share, blah, blah, blah. All these different metrics, right? You're looking at movements in the stock price. So stockcharts.com. You're looking at the candlesticks. You're looking at that stuff. You're looking at volume. You're looking at charts to identify patterns and trends. And it's a lot of focusing on the numbers and the metrics. And a lot of traders use technical analysis because getting in at certain price points when you're in a stock for a short term, you're trading it is crucial. But long-term investors use technical analysis, but most long-term investors do more of a fundamental analysis because you're less worried about the stock price or the trend today. You're looking at the future of that stock and of that company. So fundamental analysis is the other side of this. This is doing more of looking at the overall economy. So you're less looking at the stock or the company itself. You're looking at the overall economy. You're looking at the industry conditions, industry being like sector. So if we're looking at, let's just say, for example, Exxon, how's the oil and gas company, right? Or oil and gas industry. The third thing you can look at in fundamental analysis is just the financial strength of the company. So you look at the books, how's the revenue? What's their profit? What's their net income? What's their expenses? How's their debt? All these different things in fundamental analysis. And then you're also looking at the management of individual companies. So who's running the company, right?
Yeah, one of these. Yeah.
Elon Musk, right? Elon Musk, for
Man,
example.
love them shit. I ain't held hands with nobody.
So you got like Elon Musk is running, Tesla. So who is the management of this company? Who's the CEO? Who's on the board? Who's the COO, CFO? All these different things. You're looking at fundamental analysis. This was kind of made famous by Benjamin Graham, who then taught Warren Buffett. So fundamental analysis is mostly what I use when I'm investing. And a lot of buy and hold investors, as what I am, do a lot more fundamental analysis than technical, but it doesn't mean that technical is wrong and fundamental is right. It's just dependent upon what you are investing for. If you're investing for the long term, it's great to look at technical analysis, but what the movement of the stock price is today won't really matter in 10 or 20 years. But if you're trying to trade, or if you're doing options or whatever it is, technical analysis means a lot more than fundamental analysis. So like I said, we're going to run through the things that I look at when looking at a stock. I'm going to use this as an example. It's not a recommendation, but Home Depot. Just look at the stock and see what, I'll just run through it and show you all what I would look at if I was going to want to invest in Home Depot and how I would research it. So the first thing I would look at here is, like, this is the list from earlier, the historical performance of the company. Right? So you take the graph and you zoom it out to max. This is like 1981, I believe, down here at the far left. But you can see there's the upward trend, right? You can see this dip right here in 2001, around this area was from the .com. You see in 2007, 2008, 2009, it kind of dipped down. And then you had the 2020 crash, which is this one right here on the far right. But if you zoom out, you can see there's that upward trend of this stock, Home Depot, right? So just looking at the historical performance. Now, I want to make this clear that historical performance does not predict what the future performance of the company or the stock will be. However, it's good to look at. It's just good to look at and make sure, like, okay, is this company historically been growing, or has it been, not growing? How is it staying stagnant? What is going on? So it's good to use this not as a, wow, it's been up, so it's always going to go up. More of how has it been doing in the past, and that's just something to look at, historical performance.
Huh?
Next one here is the future growth of the company. So all the pictures that we see here will all be for Home Depot. I took screenshots. So all be reflective of Home Depot. We're just going to keep it the same company, the same stock throughout. There are many different, you go on Google and you type in Home Depot analyst predictions, Home Depot stock price predictions. There's going to be, thousands of predictions out there, analysts, experts, all saying this, that, and the other, right? This is just a screenshot from CNN, their website, and, they predict a 355 high, a 245 low, when it's trading at this time, when the screenshot was at 276.20. So there's so many different analysts, recommendations, predictions that you can see, and they're all going to be different, right? They're all going to say what they believe the stock is going to do. It's great to look at to see, but also do your own thinking. Like, do your own thinking. Don't just use an analyst and what they're, don't look at one and be like, wow, this analyst has to be right, or this expert or whatever it is has to be right. I'm going to use that as my recommendation. So make sure to do your own thinking, but it's good to look at. It's good just to see, what do people that do this every day for their job, what do they think this stock price will be? Again, they don't know as much, they don't know it's going to do as much as we know. It's the stock market. You can't predict anything like that. But it's just good to look at. I get, a couple questions to think about when you're doing the thought process of the future growth of the company. Do you personally think this company will continue to grow? Home Depot, for example, do you think, they'll continue to grow their revenue? Do you think they'll continue to maybe grow in store size? Do you think they'll continue to grow and, internationally possibly? Do you think the company will continue to grow? The next question you can ask is, do I see this company being used? So, for example, when I drive past a Home Depot, do I see it busy? Do I see people, buying from Home Depot? Or do I see, way more people at Lowe's than I do at Home Depot? Or, Starbucks, for example, when I drive past a Starbucks, do I always see people in line at Starbucks? Yes or no? And again, this isn't going to like tell you that their revenue is great, but it's just a good, like, quick thought. Like, if it's always busy, then, they have to be making money at some point, blah, 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 right? You can kind of just rationalize that thought process. The next thing you can ask is, will this be around in 20 to 80 years? So will this company be around in 20 to 80 years? So for example, Home Depot, do I think in the next 40 years, do I think Home Depot is going to get overtaken by a competitor of maybe Lowe's or some brand new home improvement store? Personally, I don't think so, right? I'm not recommending anything, but personally, I think Home Depot will still be around in 20 to 80 years. But that's just my thought. But these are just questions you can ask yourself. Do you think the company will grow? Do you see the company being used on the day-to-day basis? Do you think the company will be around in 20 to 80 years or 20 to 60 years or whatever you think? It's just good to look at and just start to think about it when it comes to the future growth of a company, because again, we can read all these predictions. No one will truly ever know, but it's just good to do your own thought process, especially when you're holding stocks or funds too, but for the long term. So when it comes to dividends, one thing to look at for dividend is the dividend history and the growth. This will be the history right here. I just took the screenshot today from NASDAQ.com. You put in the stock ticker and it'll show the dividends. But you can see, has the company paid out consistently? So you look and you're like, wow, okay, look, 6, 9, 12, 3, 6, 9, 12, 3, 6, 9, 12. So they're paying out consistently every single quarter back to 2016 and back more. This is just as far as I fit on the screen. The next thing you can ask is, has the dividend grown? So we look in 2016, they're paying 69 cents a quarter, and then 89 cents, then $1.03, then $1.36, then $1.50. So are they growing their dividend, or are they not growing their dividend? What if it read 69, 69, 69, 69, or possibly, and we'll get to this in a second, but is there cuts? So what if they were paying, in 2016, they were paying 69, and then in 2018, they're paying 50. So that's could be a red flag. You have to do more research and just look at this, but it could be a red flag possibly of why are they cutting their dividend. And then the third one here, I kind of skipped it, but has there been any missed payments? So like I was explaining, 6, 9, 12, 3, 6, 9, 12. Consistently since 2016, they haven't missed any payments. But if you see a company you're looking at and it's like, wow, they missed payments, then you have to do some more research and wonder, why are they missing those payments? Why are they missing that dividend? Could it be, for example, in 2020, there's a lot of companies that cut their dividends, right? Cruise lines, airlines, Boeing, just to name a couple, they cut their dividends. But you have to look at that from the, again, fundamental analysis of the economy. That's why. They didn't just cut it because they cut it. They cut it for, the pandemic. So there's a lot of things that go into it, but it's just a good little basis to see. And if there are any red flags, that's where you can dive in and look at and find out why. Why did they cut their dividend? Why did they miss the payment or stuff like that? So it's just a good basis to look at to see why and how, and then you can move forward and figure out, that kind of information. So for dividend growth, you can see, this is just a quick search of Home Depot dividend growth. The last 3 years, they've averaged 19.35% of their dividend growth. And then in the last 5 years, it's been an average of 20% growth. So not only, is the stock price appreciating, we can see here, the stock price is appreciating, but also they're paying a consistent dividend and their dividend is growing, at a 20.8% average in the last 5 years. So that's a good metric to see. Is the dividend not only getting paid out consistently every single quarter, they're not missing a payment, but they're also growing it. Like here, they grew it from 69 cents to $1.50 in just 4 years. So it's something cool to see and just see, how that dividend is growing year over year. Two good things to look at here is on Google. If you just Google dividend aristocrats, that'll pull up a list of companies that have paid 25 plus consecutive years of dividend increases, meaning, since, what would that be? 1995, basically they've increased their dividend every single year since then. And then the even bigger list is, excuse me, it's a smaller list, but greater in the sense of Dividend Kings. That list, again, just Google Dividend Kings, 50 plus years, consecutive years of dividend increases. So Dividend Aristocrats is 25 plus consecutive years. Dividend Kings is 50 plus consecutive years of dividend increases. So those are just two good lists to look at and just see companies that have consistently paid out their dividend and they're increasing their dividend for 25 plus or even 50 plus consecutive years. So this is a question that, where is the company at currently? So Home Depot, for example, or, whatever stock you're looking at, where is the company at currently? So for me personally, I'm a long-term investor, right? Hence my name, DecadeInvestor, all of my social media at DecadeInvestor. That's what I do. I hold for the long term. I plan to hold my stocks, very rarely sell stocks, but I plan to hold them for the long term. So for me, I look for solid companies and funds that I believe will continue to grow long term. So this picture right here is one of my favorite pictures. It's from a guy named, or an account, Visualize Value. But basically, this is what the market, I mean, today was a great example, right? Last week we were up, and then this week, Monday, we're down. So the day-to-day fluctuation of the market is up and down, up and down. But if you zoom it out over decades, right? Now, this isn't true for every single stock ever made, right? Companies fail, stocks go down. But when you're looking at a zoomed out, like just say S&P 500, this is what it looks like over years, right? Generally speaking, it's never guaranteed. Nothing is guaranteed in the market, but over decades, over a longer time period, we can go back here to this, see how it's a steady increase, right? This is Home Depot. It's been a successful stock in the last 20 years, but it's not guaranteed for every stock out there or every company, but it's something to look at. I personally don't worry about the day-to-day fluctuations of the market. So for example, today when the market was red, I bought into one of my ETFs, the growth ETF that was down, a couple percent. I bought into it because I plan to hold these forever. So, I buy into funds, into companies that I plan, and I buy into them because the future price of that stock or of that fund will be greater than what it is today. So I consistently buy every single week. And when there is a dip like today in certain stocks and certain funds, I buy more. Now there's always going to be that fluctuation of the market every single day. I had someone reach out to me today and ask me, is today a good time to buy or will there be a crash? Well, personally, I'm just going to continue to buy. And if there is a crash, if it does go down, if it does dip, then I'll just buy more. I'll just buy more because I'm buying into funds and into stocks that I believe that will be better or be at more value than where they are at today. So when you get a dividend, whether you get a dividend from your individual stock or whether you get a dividend from your ETF or your index fund, what do you need to do with them? So until you need that money, until you physically need that money to live or to pay bills or anything like that, I would recommend to continue to DRIP. DRIP stands for Dividend Reinvestment Plan. Basically taking your dividends that you're getting and putting them right back into your stocks, putting them right back into your funds. So this is a tweet I put out in the beginning of the year about he put out his dividend income. And I just I'll leave it on here for a second and talk. As I talk, you can take a second and look at it. But basically, when you DRIP your dividends, meaning whenever you take the dividend from Apple or you take the dividend from, Exxon or whatever it is, and you put it right back into that stock, then the next time you get a dividend payment, you'll have more shares, which would equal more dividends. And you put that in and it grows and it continues to compound year over year, quarter over quarter. And it can grow into massive amounts of money with only a little bit of money, right? Because compound interest just is a powerful thing. It's the eighth wonder of the world. So this is just a thread I put together at the beginning of the year, just showing you how dividend reinvesting, dripping is called, dripping your dividends back into your portfolio, how much it can grow to, right? So, in 2021, $181,000. At year 50, it could be $61 million in dividends. That's in dividends every single year. So it's just something to keep in mind until you need those dividends. Majority of people say to drip it, put it right back in, continue to buy more shares of the companies or the funds that you believe in. So here are some more technical analysis metrics you can look at. So for example, RSI, Relative Strength Index. This is what Home Depot's was at today, 49.18. It's between 0 and 100. The stock is overbought when above 70 and oversold when below 30. So that's a good metric you can look at when it comes to buying into these stocks. But again, personally, I don't really use this because I'm playing to hold for the long term. But if you're trading or if you're swing trading or it's something you definitely need to pay attention to. PE ratio is price to earnings ratio. Home Depot was at 23.91 as of today. And basically, like this says, it relates the share price to earnings per share. So it's just something you can look at. It differs amongst industries for what's a good PE ratio. Historically, 15 is kind of what it's been. However, it depends on the sector. Tech companies have a huge PE ratio, or maybe not a PE ratio. It just depends on, you have to have profit, and there's a lot of things that come into play. But PE ratio is one to take a look at. It's just a good little metric. Again, you use these not to less to look at one and that's why you buy. You put them together. You put all these together when picking out what you want to do. Other ratios is the PEG ratio, the debt to equity ratio, the earnings per share ratio, and the CAGR ratio or return, excuse me, are just different metrics you can look at when picking a stock. But again, for me, it's less about this, more fundamental analysis and buying into companies that I believe or funds that I believe will be worth more tomorrow than they are today. So I know it's a lot of information on picking stocks and picking individual companies. If you aren't really sure, if you're confused, you're like, oh, I don't know if I feel comfortable picking this or that, then just start with index funds or ETFs. Start with them, put your money in there until you learn, right? At least get your money in the market. But don't buy into stocks that you don't feel comfortable, or don't make moves if you don't feel comfortable. Buy into index funds, ETFs, learn how it goes, and then you can make that transition over to individual stocks. But if you aren't sure, you don't feel comfortable, that's what I recommend, is just starting with index funds and ETFs. That'll be a great way to get your money in the market working for you while you're still learning individual stocks. So this is just like an interesting thing I put together. People ask, how do your dividends increase? So there's three ways that these aren't the only three, but these are three big ways that your dividends will increase. Number one is through drip. Like I was explaining with that thread on that tweet. You get a dividend, you put it back in that company. Next quarter, you have more shares, so you have a little bit more dividends, and you reinvest that, you drip in it. That's how that will grow. The next one is personal contributions, meaning every single week, every single month, every single quarter, whatever it is, you're putting money into your portfolio, meaning you're buying more shares, which will mean you're getting more dividends. And the third one is the company decides to increase the dividend. So we saw with Home Depot, it was 20%, 19 or 20% for the last 5 years. So that if the company decides to increase their dividend, and that's another way that your dividends will increase. So you can put these three together, and that's a massive way for your dividends, whether it be through your index funds, ETFs, or individual stocks. Those are great ways for your dividends to increase. So this is the last slide, and then we'll do some questions. But how do we reach financial freedom? It's always talked about on Twitter. I always post about it or tweet about it. How do we reach financial freedom? Well, number one is we have to start today, right? We have to get our money working for us somewhere. And we saw from the beginning, the savings account when it comes to building wealth is just not going to cut it right now. And so we have to start today putting our money, in the market, putting it at least somewhere where it's going to earn us better than 0.05%. The second thing is to take your quick money. So whether that comes from trading, from flipping, from your side hustle, whatever it is, taking that money and putting it into long-term holds. Why is that? Because when you're taking that quick money, right, instead of spending it, you make $1,000 from flipping in the month or whatever it is. Instead of spending it, you put it into your portfolio. That's $1,000 a month. That's $12,000 a year. and you get those, say you put it into VYM, which is a high dividend yield ETF. You put it in there and it'll compound over itself. And that, that 1,000 that you made from that quick money from flipping or trading or side hustle, whatever it is now your forever money, and it's earning you dividends, which hopefully you're reinvesting, and in 10 or 20 years it's worth a lot of money, and you're still getting decent dividends from that. The third way is to just be patient. I think especially nowadays in our society, we want instant gratification. We want things now. But compound interest needs time. Compound interest needs time to get to work. Compound interest needs time to start working for you. So just be patient, continue to, invest every single week or month, consistently invest, and just be patient. And as you add more, compound interest will start to take the load off your shoulders and put it onto, its shoulders. So just be patient. The fourth thing here is just keep investing. Like I've been, I'm kind of saying the same things in different ways, but just keep investing even through the ups and downs. That's like the last one here. Don't sell the dips, especially when you're investing into great funds or great stocks that, it's just a hiccup essentially, or, 2020, right? Early 2020 when the market crashed. Don't sell the dips, buy more. Now, that's not always going to be the case for, some companies. If you're investing in a smaller company, they might not be able to make it out of that dip. But when you're investing into, companies that you've done your research on, and, big companies and S&P 500 index funds or ETFs, don't sell the dips, don't fear, and buy more. The last one is just let's go. We're in the Wealth Squad. We want to get better, right? We all are here to better ourselves, create generational wealth, better our lives, all these things. We got to do these things to reach financial freedom, but it's definitely worth it. It's not easy, but it's worth it. So with that being said, that's the presentation. I'm going to open up for questions here. And if anyone, just shout them out. I'll stay on here for another, 30, 40 minutes until there's no more questions. But with that being said, I appreciate you guys. Again, I'm DecadeInvestor on Twitter and Instagram. So if you have any questions or if you think of any in the future at least, or if I don't get to you today, send me a message on either of those, Twitter or Instagram, and I'll get to you as soon as I can. But let's open up the floor for questions. So just start shouting out, and then, we'll get to it as we go. But appreciate you guys. And yeah, let's open up for questions.
Hey, thank you for everything. Quick question. So how many ETFs do you recommend being invested in? Of course, doing your due diligence and research and fundamental analysis, how many do you recommend being invested in?
So for me, I would say I wouldn't over diversify. So let's say, for example, you're in, so let me just say for me personally, in my Roth in particular, I have two index funds and one ETF that I'm invested in. I would say sticking with like 3 to 4, anything over 5 is a little too much, because there's a lot of overlap in these ETFs and index funds. So I would say, make sure there's not too much overlap, but 3 to 5, anything below 5 is you're going to pretty well diversified.
Perfect. Thank you so much. And thank you for this, by the way. Appreciate it.
Yeah, no problem. And sorry to interrupt everyone for asking questions, but this will be recorded and posted in the Wealth Squad University. So if you have any questions or you want to see another slide, it will be posted in the next couple of days in there. So you can go back there and watch it.
I have a question.
Yeah.
What would you recommend, or can you speak more on traditional investing for people that are looking for to do more swing trades?
So I don't do any swing trades personally. So I don't want to say like what I recommend because I don't do it. So I don't have an answer. But if you send me either a message on the Discord or on my social media, I will connect you with someone that will chat with you for free to answer that question, or at least give you some more guidance on that, because I personally don't do it and I don't want to lead you down the wrong path.
What would
Thanks.
Yep.
Yeah, what were those first couple stocks you mentioned as far as dividend stocks?
So in the slides, I was talking about Home Depot. But honestly, I would say to the best way, because I don't, I'm not gonna recommend anyone any stocks here or anything.
Not as
I would just go to either the Dividend Aristocrats list or the Dividend Kings list. And on Google, just search Dividend Aristocrats or Dividend Kings, and you're able to, get a big list of companies that have paid consistently over 25 or 50 plus consecutive years. and start your research there.
Thank you.
Yeah, I know there's some guys, some people have questions, or excuse me, their hands up. So I'm gonna get a couple hands first, and then we'll go back to just shouting out. So let's see. The first hand I see is Brenda.
Hello. So I have about $12,000 in my 401k plan that I used to have through my job. And do you think it would be a good idea to like take that money out of there and invest it in stocks instead of just having it? Because I know it's in stocks, but I don't think it would have as much growth as it would if I did like stocks or whatever you've been mentioning.
Yeah. So the thing with 401ks or any retirement accounts, other than a Roth IRA, but in your case, a 401k. So if you were to take that money out, you would end up paying taxes, and you'd have a 10% penalty on that money. So right off the bat, you're gonna, if it's at 12,000, 10% is 1,200 plus the taxes on that. So it's gonna eat into that $12,000 value. So what I would do is
Can you transfer it to a different account, like an IRA account or something?
Yeah, you could do that. You could roll it over into a traditional IRA, and that would just be working with the brokerage and possibly your last employer, whoever that 401k is through. But if you did that and you rolled it over into a traditional IRA, then you wouldn't pay any taxes since you're transferring it into the same, not the same, but the similar tax retirement account. So that would be a way to do it that way. But even if you transfer it to the traditional IRA and you pull it out there, you still pay the taxes and the penalty. So if that's what you want to do, then I would go doing the traditional IRA rollover. That way you don't pay the taxes nor the penalty.
Okay, thank you.
Yep. John.
Hey, how you doing? Just want to say thank you again. This was a real good, clear presentation and very eye-opening. But my question for you is, because it's something I want to start doing, what's a good percentage that maybe one should look to put in bi-weekly to invest? I don't want to say, a certain cash number because I know everybody's bankroll is different, but what's a good amount to start to invest?
Yeah. So I appreciate the words. And I hope that this presentation was helpful for everybody. I would say, so personally, if you can do, 10 at a minimum, if you can do 10% of your portfolio, 10% of your income into your portfolio for the year, just 10%. So bi-weekly, just 10% of every paycheck at a minimum. That'll be great. If you can do more, that's awesome. 15, 20%. But I would start at least, if you've never invested in you're kind of hesitant or whatever it is, start with 10%. And then if you want to do more, then you at least have that ground, that 10% set, and you can find other ways to either increase your income or find in your budget ways to get, maybe 15%. But I would definitely start with 10%. That's a great starting point.
Thank you. I appreciate it, man. And like I said, great information. Definitely appreciate you.
Yeah, appreciate it. Thank you. Nick.
Hey, how's it going?
Good. How are you?
Good. Thank you again for this presentation. Super eye-opening, very, very helpful. I won't be too long, but the one question I had, and it's just something that I've been focusing on as I'm getting more dialed into reading about stocks and doing the analysis, and you mentioned it, is volume. And I guess I understand the general implications of volume, what it is, what it represents, but when you're reading it in a technical analysis, like what are you exactly looking for? Are you looking for, like if I'm on, say, FinViz and I look up Home Depot, you can go and see the volume there. And is that, I know there's probably a bunch of different answers, but is that the main thing that you're looking for? Are you just looking to see that like the volume is trending the same way that the price is trending?
Yeah. So, great question. I would say, well, first off, like I wouldn't use, like you want to put a lot of different analyses together to, metrics together to when picking a stock. But volume is something good to look at just to see that, the day-to-day trading volume of that stock is staying pretty consistent, or because you don't, especially whenever if you're trading, let's say, if it's in the trading sense, you don't want to trade a stock that has very little volume because the price isn't going to fluctuate a lot, right?
Right. Okay.
Right. So it's less about like, is the volume growing? It's more about, is just the volume at a solid, level is what it's been, or is it a volume at the point where the price is going to fluctuate enough that if I were to trade it, that I could see, it's not going to not change in dollar value every day because no one's trading it type thing.
Right. Yeah, that totally makes sense. Thank you very much. And again, great presentation.
Yeah, no problem. Thank you.
Cheers.
Yep. Diamond.
Hi.
Hello.
I had a question. I wanted to know, what is the best way to shop for stocks?
Yeah, so I would say number one, if you're new to the market, I would go with index funds, ETFs, broad market. Just learn how the market kind of goes and allow yourself to see your portfolio go down 3% on the day and not like fear, want to sell. But if you're going for individual stocks, I would say starting with companies that so like Starbucks, Apple, Home Depot, Lowe's, stocks that and research those. And then if you're wanting to get in more of like growth stocks or like stocks like DraftKings or something where maybe it doesn't have that books, the financials aren't really there, it's a new company, you want to see that big return, that's a lot harder to do because there's not much to research on those compared to like your Apples or whatever. But I would say if you want to do individual, start with companies and stocks that does that make sense?
Yeah. Okay.
So when I started my like individual portfolio, the first stocks that I bought were like, again, Apple, Microsoft, Starbucks, Target, stocks that I use or I see people use every day. And now I was able to then research, because a lot of things people use or services, not a lot, but quite a bit of them are companies you can invest in. And so you can see that and be like, wow, okay, like I see everyone using iPhone, so let me go do a little research on Apple and see if I want to invest in it. Does that answer your question?
Yeah, when you had said seeing the stock drop down 3% for that day and like not freak out, when you see it like say drop down to 4%, is it a good idea to sell and then allow for it to get lower and then buy back in?
So that's a great question. The reason I say that's not a good idea is because I'm just going to say, for example, let's say it lost 4% and you sold, right? And you're like, okay, I'm going to wait till it drops a little bit more. What if that stock never went down again and then it just turned right back up and never hit that price again? So you lost out, you know what I mean? So it sounds good in theory, but it's really, really, no one can time the market that way.
Right.
So what I do is when I see that 4% or 3% drop, I'll actually, instead of selling, I'll just buy a little bit more. That way the average cost of my shares go down a little bit. And I'm getting into that price, but I'm not selling. And, if it doesn't go back down ever again, at least I got something. I didn't sell off and then it shoot back up, and never hit that again. And I lost out on all those gains.
Right. Okay. Thank you. Oh, and if you don't mind, can you post your IG and Twitter in the comments?
Yeah.
I mean, in the chat. Thank you so much.
Yep. Burhan, I believe. Sorry if I say names wrong. Okay. Delonte.
Hello?
Oh yeah. Okay. Yep. I can hear you.
Sorry. Yeah. I
you're
did
good.
that. Yeah. No, I just have a quick question. I've been investing a long time in a mutual fund, and it's the same mutual fund. I just have one, and it's a total, I guess it invests in the entire market. And I wanted to know, is there an advantage to this ETFs that I keep hearing about over the mutual fund?
No. So the really the only difference between a mutual fund, index fund, and an ETF is when the trades are executed. So basically, with an ETF, so like you said a total stock market, right? So the index fund would be like for example, one is VTSAX, which is
that's the one I own. Yep.
Okay. So VTSAX, the ETF equivalent is VTI, and what the difference is that the holdings themselves are the exact same, right? The percentage of the investments are the same within that. The only difference is if I buy VTI, let's say I buy it at 10:15 a.m., then that trade will get executed for that price because the price fluctuates every single second, like just like a stock does. With a mutual fund or index fund, it's the trade happens or the sell happens after the market is closed at the end of the day. So you're not really like the only reason people go for ETF versus index fund in that sense is that they can buy and sell at certain prices throughout the day. But if you're doing it for the long term, then it really doesn't necessarily matter. I do index funds mostly. I have a couple ETFs that I do that just because they don't have index fund equivalents. But there's really no other than how it trades essentially, like either versus the price changes daily like a stock or it happens after the market's closed. It doesn't do. There's really no other difference other than possibly the mutual fund being actively managed, but that's not always the case. Index funds are passively managed, so but mainly just as the price changing throughout the day.
So you don't recommend, like, should I split it up half and half or just keep it as what I'm doing now?
Yeah. So you're saying like half VTSAX and half VTI?
Yeah, I think they're both Vanguard, right?
Yeah. No. I wouldn't because it's the same holdings. And there's really there's no you would just be. I mean, I guess there's not a downside, but there's no benefit of doing that.
Got you. Okay. Thank you.
Yep. No problem. Delonte.
Yeah, so my quick question is, I know you gave a couple of metrics out, and I was just wondering which ones do you give like more weight to? Do you more so focus on the CAGR, EPSs, PE ratios?
Yeah. So honestly, for me, I do now I'm at the point where I'm not really adding any stocks to my portfolio, and then I do a lot of index funds. But when I was picking, a lot of the times I liked PE ratio is kind of what I recommend using more than just one, or even two or three, using a couple, like 5, 6, 7, whatever it is, using multiple. But I like PE ratio to look at just because you're able to see, you can compare it to other stocks in the industry and see what, that stock is versus what, Apple versus Microsoft or whatever it is. Also the PEG ratio, which is price earnings and then includes growth. The future growth, or past growth. But anyways, so PE ratio and PEG ratio were two that I put a little bit more weight on, but I like to look at, more than just those two.
All right. Thank you.
Yep. Delita.
Hi, how are you?
Good. How are you?
Good. I have two quick questions. The first one, if you can please share with us the funds that you are currently investing in your Roth